This interview is for information only and should not be considered as investment advice or a recommendation to buy shares in the company featured. Welcome to this Stock Box interview. Well, joining us today is Adam Wilson, the CEO of Ben's Creek, and Aron Binning, the CFO, following the publication of the company's annual report, where the CEO reports a successful restart of mining operations at Glen Allen. Well, thank you very much, Adam, for joining us today. How are you?
Yeah, we're very well, Mark. Nice to see you again.
Indeed. Well, thank you very much for joining us. So could you just give us some of the highlights, really, of this report that's come out now, from your point of view, looking over the last year?
Sure. Thank you very much. We actually, these are the first set of results where we've actually sold clean coal. So we sold 240,000 clean tons in the year up to March. So these are slightly out of date in terms of current production. In that period, we made a 24 million loss, although that is largely a paper loss. The previous year, we took a 33 million gain on putting a bargain asset on the balance sheet, which is really the reserves and the wash plant. And as we bought equipment to bring this mine in production, we've had to depreciate those assets. So the actual underlying adjusted EBITDA is an 8 million loss. And that loss was spread over the 230,000 tons we sold. However, in the period, post-period, the production has gone up. The cost of mining has come down. And most importantly, the commodity price, the high vol B price, has gone from a low of 191 to currently 238. So that's some $47. So whilst it's disappointing to the end of March that we made an 8 million loss, those three factors will transform the next set of financial figures.
So revenues are up 800%, aren't they, on the year there? But of course, you have reported the loss, and you say that's mainly due to the met coal prices, but also you've had some operational challenges, particularly with the weather situation last year, but also a high waller getting stuck. How are you going to address these sort of issues going forward? Of course, the met coal price is out of your control.
Well, the met coal price has rebounded already, so that's now, $30 a ton loss is now into profit. We've cut costs on the whole mining operation. The high wall miner is now up and running, and as of September the 11th, we've got 2 high wall miners, producing. So a lot of those factors have been overcome, and as I say, most of the loss in the last year, in those set of accounts that are a sort of non-cash loss. The adjusted EBITDA was an 8 million loss divided against the sales of 230,000 tons. Obviously, as you produce more coal, per ton, the cost shrinks relatively. So we produce more coal post the period end. The cost of production has gone from 128 to 111, as detailed in the financial accounts, and the loss to profit on the coal has gone from 191 at the low point to today it's 238. So we've gone from a loss-making situation to a profit situation post the year end.
And your break-even price on a met coal price, what would that be?
It's about 111 net 111. To us. Now but that 111, you have to add about $45 of transport for the coal, and then you have to take off 20% from the index, which is quite confusing because the index is in metric tons, and we sell in short tons, and there's normally a broker commission involved for selling it. So if very simply, if you take $100 off the published price, 238 brings you back to 138, and so that's it's a little bit more. A little bit less than $100 that comes off, but that gives you an example. So 128, when it was 198, we were $91. Now it's 238, we're $138. We've gone from loss to profit.
Sure. So you can confidently say you've gone from loss to profit then, and maybe in next year's account you'll be reporting a profit.
We can say that, yes. Obviously, we don't know what's going to happen to the end of March. Anything could happen, but on a August-September run rate, yes, we are in profit.
And in terms of operational risks, Adam, what might affect this? Of course, the storm was an issue last year. The high wall are getting stuck. Have you taken measures to reduce any downtime?
Yes, we've got 2 high wall miners now, so we can, and we have a spare shift on the weekends to fill that in if this happened again. We've got more equipment than we had last year. One of the factors in the paper loss was the adding of a new fleet and the 1 out of 5 years depreciation. So we got much more benching equipment than we had last year. Easy to remediate any potential disasters. The storm we talked about last year was a once in 30 years storm. We're not expecting, hopefully, that kind of thing again. So we've got more equipment. We've got much more. We've got an extra day at the weekend to fill in if we do get behind. So we really are hoping that the sort of problems are behind us, Mark.
Okay, and you of course have transitioned from the owner operator mode to the owner operator mode from the contractor fleet as well. So that helps you as well. You're master of your own destiny, so to speak, here. Then
100%. Well, that only happened in Thanksgiving. So for the large part of last year, which these results relate to, we had a contractor, and if the contractor won't work because of weather or what have you, we've got no way of forcing it. Now we've owned our own equipment, and in fact, we increased our fleet only fairly recently with an excavator, which we announced. And, against this background, in terms of the prices, 3 other mining companies in the area last year with the low prices issued WARN, WARN, which is short for warning notices. And they're about 2.5 million tons of production has come out of the local market, which is why I think we're seeing a steady rise in prices.
Okay.
The futures for the end of the year are priced higher than they are now. That's no guarantee, but I am confident the pricing will stay where it is or even get stronger going forward. And at where we are selling coal now, we are all sold out to the end of the year. We are selling well into profitable pricing.
Okay, so it's good to hear that you're into profitable pricing, sold out to the end of the year. The final question I have for you then, Adam, is of course on your reserves, and you reported an update in reserves following the permit grant. So what are the reserves looking like, and were you looking to do any more further resource updating?
We intend to continually update the reserves. If you look at the accounts, there was no drop in the reserve, despite us clearly depleting the reserve in the year. So each year we're hoping to accrete just as much as we are mining at the bare minimum. We've got about 92 million tons in situ. We then probably, it's a reserve and a resource. Both the reserve and the resource are continually rising. We have to have depletion because obviously the reserves were lifted onto the balance sheet at a certain price. But this year we saw our depletion rate halve by adding additional tonnage, and we expect that to continue every year we're mining. This mine will long outlast me, and even Aron, who's 10 years younger, he'll still be here for more than 10 years younger. He's prodding me. He will be here. The mine will be here a lot longer than he is.
Okay. Well, thank you both very much for your time today. It's good to hear and see you both looking very buoyant about the company's future prospects. Thank you very much for your time, and I look forward to following up later on.
Appreciate it. Thanks a lot.
If you enjoyed this interview, then give us a thumbs up, a like or a retweet. Subscribe to us on YouTube or follow us on Twitter, and hit that notification bell to be the first to know when we release new content. There's loads of great content on our website too, across all our programs at stopboxmedia.com. Thank you for watching.